If I handed you $10,000 right now, would you try to flip it into $11,000 by next Friday? Or turn it into 100 grand by the time your hairline starts negotiating with gravity? Because that, my friends, is the difference between trading and investing. One is fast, exciting, and slightly chaotic. The financial version of an energy drink. The other is slow, powerful, and about as thrilling as watching paint dry. Except the paint is compounding in value while it dries. And here's something wild. JP Morgan's long-term market data shows that if you miss just the 10 best days in the S&P 500 over a 20-year period, your total return would be cut roughly in half. So if your strategy is jump in and out whenever I feel nervous, congratulations. You've invented a system for deleting your own profits with expert precision. I'm Jack. I break down money, markets, and investing, so it actually makes sense. And occasionally so, you can impress people at dinner by saying compound interest without sounding like a spreadsheet. If you want smarter money moves and fewer financial faceplants, hit like, subscribe, and let's dig in. Trading versus investing explained. So, here's the deal. Trading and investing both involve buying assets and hoping they go up. Same app, same tickers, same buttons. Completely different mindsets. Trading is like speed dating the stock market. Investing is like marrying the market and arguing about dividends for 30 years. The trader's mindset. Now let's step into the trader's world. Traders care about what a stock does tomorrow. Investors care about whether the company still dominates in 10 years. One is binge-watching charts like a reality show finale. The other is reading annual reports and pretending that's fun. Trading leans on technical analysis, basically staring at charts long enough that patterns start appearing somewhere around your third coffee. Candlesticks, support, resistance, moving averages. Sounds medieval, but it's really crowd psychology on a graph. Yes, some traders make money. The good ones treat it like chess. Probabilities, discipline, cutting losses fast. But even pros with 6 monitors and enough caffeine to power a small city only aim to be right about 55 to 60% of the time. Losing isn't a mistake. It's part of the job. You buy at $100, sell at $110, feel like a genius, start pricing yachts. Then the next trade drops 10%, and you're stress-eating cereal straight from the box. That's because losses hurt more than gains feel good. Behavioral finance shows losing $1 feels about 2 times as painful as gaining $1. Trading isn't just math, it's emotional damage control. Risk management and trading styles. That's why traders use stop losses, pre-planned escape hatches for your money. You decide in advance how much pain you'll take before you're out. It's the financial version of, if this date mentions their NFT collection in the first 5 minutes, I'm leaving. Trading styles mostly differ by how much sleep you're willing to sacrifice. Day trading is the extreme sport. In and out within minutes, and in the US, you typically need $25,000 to do it regularly because regulators assume that much clicking requires adult supervision. Swing trading holds positions for days or weeks. Slightly less caffeine, slightly fewer heart palpitations. Position trading lasts months, which is basically trading slowly turning into investing, but still insisting it's edgy. Like, I'm not long-term, I'm just very committed short-term. Other trading markets. Traders don't just trade stocks, they're in Forex, commodities, options, and of course crypto. Crypto trading is like normal trading, except the roller coaster runs 24/7, the seatbelt is optional, and your portfolio can swing 10% while you're brushing your teeth. Here's the reality check. Brokerage data and Spiva studies show most active traders and fund managers underperform simple index funds over time. Not because they're clueless, but because they overtrade, get emotional, and underestimate the silent killers. Spreads, fees, slippage, and taxes. Every click takes a bite out of your returns. Trading isn't impossible, but it's closer to a full-time job than a weekend hobby. It takes screen time, discipline, tested strategies, and the ability not to panic when the market does something weird, and which is basically every other Tuesday. It's like professional poker. Part math, part psychology, part risk control. And most people lose because they don't realize they're playing against people who've practiced longer and are very comfortable taking their money. The investor's approach. Now let's slow down and talk about investing, because this is where most people should actually be spending their energy. Investing is the long game. You buy quality assets, hold them through the noise, and let time do its thing. Instead of asking, what's the price tomorrow, you're asking, will this business be better, stronger, and more profitable in 10 years? Investors rely on fundamental analysis. That's revenue, earnings, cash flow, debt, profit margins, management quality, competitive advantages, all the boring sounding but powerful stuff that determines whether a company actually makes money and can keep doing it. It's less about chart patterns and more about business stories, who makes the product, how they compete, and whether people will still care in a decade. And guess what? This boring, methodical approach works beautifully over time. The power of compounding. Historically, the S&P 500 has averaged about 10% per year over long periods. Not every year, but over decades it evens out. Put in $10,000, let it compound at 10% for 30 years, and you're looking at roughly $174,000. That's not timing the market. That's letting math do the heavy lifting. Compounding feels slow at first, then suddenly ridiculous. You start earning returns on your returns on your returns. Finance's closest thing to a superpower. It's like going to the gym. Nothing happens for months. Then one day your jeans fit, your back stops hurting, and you can carry all the groceries in one trip. Investing works the same way. Invisible progress that eventually becomes very visible. Dividends and passive income. Another big reason investing quietly wins over time is dividends. With dividend-paying stocks, the company literally pays you a slice of its profits just for being a shareholder. Over long periods, dividends plus the growth of those dividends have made up a huge chunk of total market returns. So you're not just hoping the price climbs. You're getting paid to wait. That's like earning rent on your capital while the property itself becomes more valuable. That's also how a lot of retirees live off their investments. A big, diversified portfolio of dividend-paying companies or funds can throw off regular cash flow while still growing in the background. Consistent investing example. Let's make it concrete. Invest $500 a month into a low-cost S&P 500 index fund. Reinvest the dividends, ignore CNBC's dramatic soundtrack, and you're at roughly $103,000 after 10 years, $379,000 after 20, and near $1 million after 30 at about 10% returns. That's consistency plus compounding doing the heavy lifting. Here's the part that annoys Wall Street. Spiva data shows 80 to 90% of fund managers fail to beat the index long-term, especially after fees. So the boring buy and hold strategy usually wins. Boring wins. Boring gets rich. Warren Buffett proved it. Over 90% of his wealth came after 50, thanks to decades of compounding. His favorite holding period is forever, which basically means buy quality, ignore the market's mood swings, and let time do the work. Trading versus investing. Which wins? So which makes more money? Trading or investing? Trading can make money faster, no question. You can have huge up days, but it's inconsistent, stressful, and very hard to repeat for decades. Investing is slower, steadier, and statistically more reliable, especially if you diversify and keep costs low. It's the difference between a sprint and a marathon. Both take skill, but only one is designed to last without your lungs filing for divorce. For most people with jobs, families, and a need for sleep, long-term investing in low-cost funds has the best track record. Trading can still be fun. Just treat it like dessert, not the main course. Invest first, trade later. Common investor mistakes. Beginners tend to fall into the same traps. They try to get rich fast. They panic sell during dips. They chase the hype they saw on social media. They overtrade. And they ignore fees and taxes, which are like tiny piranhas quietly nibbling away at their returns. Vanguard's research and others show that investors who simply stay invested through downturns usually crush the returns of people who keep trying to time every move. Missing just a handful of the market's best days, which often happen right after the worst days, can absolutely wreck your long-term performance. So when markets tank, remember, corrections are basically sales. You're getting good assets at cheaper prices, not being personally attacked by the universe. Tax-advantaged accounts. If you're in the US, one of the smartest ways to invest is through tax-advantaged accounts. That's your 401k if your employer offers a match. That match is literally free money. And your Roth IRA if you qualify, where your investments grow tax-free, and withdrawals in retirement are tax-free too, under current rules. Contribution limits are updated regularly by the IRS, but the core idea doesn't change. Use these wrappers so more of your growth stays in your pocket instead of going to the government. If you're in the UK, think in terms of your stocks and shares, ISA, and workplace pension schemes. Similar concept, different acronyms. You shelter your investments so they can grow without taking a yearly tax punch. The earlier you start, the more those tax advantages and compounding team up in your favor. The key idea is this. Every year you delay, you're not only missing that year's possible return, you're missing all the future compounding on that year's contribution. Long-term market reality. Zooming out, the US market has survived wars, inflation, crashes, bubbles, the whole Netflix drama catalog, and still trended upward over time, rewarding patient investors. The perfect time to invest never feels perfect. The scary headlines that make people run often end up looking like great entry points on a long-term chart. If you'd bought a broad index fund during the 2008 crash or the 2020 pandemic drop and simply held on, a few years later you'd likely be sitting on solid gains. Markets wobble constantly, but over long stretches they've historically rewarded people who stayed in their seats. So trading or investing? If you want entertainment, trading delivers adrenaline, stories, and a few gray hairs. If you want wealth, investing wins. Trading is trying to catch lightning. Investing is building solar panels and collecting sunlight for decades. And no, checking your portfolio every 9 minutes doesn't speed up returns. I've tested it. It only increases your heart rate. Your money doesn't need babysitting. It needs time, consistency, and a boring plan. If this video helped you finally understand the difference between trading and investing, hit like, subscribe, and start your financially free journey. Remember, fast money stories make headlines, but slow money stories build legacies.